Thanks, Jen, and welcome, everyone. I know Meredith, Tom, and I are excited to share some of this year's key findings from the 2021 CSBS National Survey of Community Banks. You know, as we were preparing for this year's presentation, I remember Mike Stevens, who presented with me on this panel last year, and he started off by saying, based on a discussion that he had with a reporter, that reading the 2020 survey publication is like reading a cliffhanger. You don't really know what is going to happen, and you have to get to next year to really hear the rest of the story. Well, today we are here sharing the 2021 story. Not only did we introduce new questions and see how this year has changed in terms of last year, where the questions really focused on understanding the early stages of the pandemic and the immediate operational impact community banks were facing. This year, we have a little bit more backstory and context in terms of understanding the challenges and opportunities currently facing community banks a year out. We're seeing that former operational problems have created some newfound efficiencies. We're seeing that bankers are worried about insufficient rather than excessive loan demand, but are more optimistic about the long-term prospects for small business lending. We're also starting to see that bankers are embracing technologies that they may have formerly avoided. So we'll be digging into some of these findings shortly. Just a high-level overview of this year's survey. The CSBS National Survey of Community Banks was distributed from April through July, and we had a pretty impressive showing. There were 470 responses this year, which exceeded last year's total, perhaps showing that we're starting to get used to this virtual world and feeling more comfortable with expressing our voices. We also wanted to thank the commissioners and the bankers for responding to the survey. You know, the Community Bank Planning Committee, we take a lot of time in putting together a comprehensive survey, but ultimately it's really up to the commissioners and then the bankers to share their voice. So we really appreciate the time you've taken to respond to this year's survey. Now, if you want to learn more, please check out the communitybanking.org website for the complete publication with the survey results. Today, Meredith will be sharing the key findings, and Tom will be supplementing that quantitative piece by putting the results in a little bit more context by showing some historical data as well as related materials. But before we dive into some of the new key findings, we felt it was important to share or start off with what has remained about the same since last year. So Meredith, could you report on what we saw with respect to issues such as regulatory risk, LIBOR, and CECL?
Great. Thanks so much, Alicia, and good afternoon, everyone. I'm Meredith Covington. As Alicia said, I'm going to be running through the top findings of our survey this year, and Tom will be providing supplemental insight from other sources of banking and economic data. We wanted to start off with a few areas that remained similar to last year and in previous years. So we know that the vast majority of bankers still view regulatory risk as important or very important. And this is despite the positive attitudes that bankers had about regulators' response to the pandemic. Among banks with a significant exposure to LIBOR, 62% have a plan in place for replacing it, while more than 10% of bankers said they had already made the transition. And then lastly, community bankers are not rushing to convert to CECL. Nearly 2/3 of them are planning to defer their implementation to 2023. All this said, we understand while sentiments haven't changed much, there are still new regulatory issues that face bankers all of the time. We're going to be addressing some of the more timely regulatory issues through one of our research panels actually tomorrow, if you're interested. That panel is called The Unintended Effects of Oversight. We do have several findings that are unique to this year, so we'll get started discussing those. And Alicia, I'll turn it back over to you.
Great, thanks, Meredith. Community bankers today are facing a very different array of challenges than they did prior to and certainly at the height of the pandemic. Meredith, can you speak to some of those external challenges, particularly net interest margins, and tie it to what we're seeing on loan demand and cost of funds?
Sure. So our first big finding is that maintaining and growing net interest margins are problematic for most bankers right now. They were actually named by 65% of bankers as a very important external challenge, which was the highest of any category. We think this presumably reflects a drop in margins for the banking industry to 2.65% in the first quarter of the year, which was a record low, as yields on assets declined more than rates on liabilities. Some, but not all, bankers that responded to the survey said that they expected low rates to persist for the foreseeable future. Tied to the net interest margins are these two findings. So 52% of bankers cited loan demand and 22% cited cost of funds as both being very important challenges. Last year, the cost of funds barely registered as a concern, but this year, the greater concern may reflect some of the economic strains imposed by the pandemic. Also last year, at the height of the pandemic, business conditions were named by 34% of surveyed bankers as their single greatest challenge, which was quadruple the level recorded by loan demand. This year, the situation reversed. Only 28% of bankers described business conditions as being a very important challenge. So I'm going to turn to Tom now, and he's going to share some additional findings that he's seeing regarding net interest margins.
Thanks, Meredith. First of all, just as the CSBS economist, I just want to thank all the community bankers out there that have responded to this annual survey, and also to the commissioners and the state regulators for their help in getting the word out about that survey. And I'll also take this as an opportunity to plug the quarterly CBSI, which is the Community Bank Sentiment Index that we do through CSBS. And that has a lot of importance, and we need good response on that as well. You know, it takes 4 to 5 minutes to complete and really helps us to understand how community bankers are thinking about the outlook and what their major areas of concern are. So with that plug out of the way, we can see in this chart that net interest margins have been severely squeezed, particularly over the past 2 years. And this next chart shows that that there's also been a significant fall off in loan demand. So I'm not seeing that chart yet. There we go. There's also been a significant fall off in loan demand, and especially again since 2019. And so as a result of these things, this is why this is the top concern. This next chart shows us that banks are clearly concerned about where they're going to earn profits. Their potential for earning profits has declined here from the earning assets, and so they're very concerned about that. This map shows us where the banks are that have had the most severe NIM compression over the past year. It's showing the top 20% of the community banks, and these were the banks that had a NIM compression of 37 basis points or more.
Thanks, Tom. You know, to summarize, we see that many community banks are wondering, again, how will they earn profits in an environment characterized by low interest rates, declining loan demand, and lots of liquidity. We'll be talking about technology in a few minutes, but indeed, you know, it appears that it will be more important than ever for community banks to be efficient and supportive of adopting new digital technologies. So moving on, as expected, since last year, there is less reliance on lending through the Paycheck Protection Program, or PPP. And the questions we asked were, again, more focused on the operational aspects of PPP last year and how community banks were handling the rollout of the PPP. So Meredith, could you speak further to what we saw in the PPP and new lending opportunities in 2021, including relationships with customers?
Sure, thanks, Alicia. So our second big finding from the survey is that the PPP increased propensity for credit risk and lending activity, both in the short and long term. As we all know, the Small Business Administration was a popular vehicle for lending under the PPP, and its prominence was really underscored by last year's survey. 77% of banks offered loans through the SBA and plan to continue offering them in the future. While this dropped to 70% this year, that can really be explained by the program and its phases winding down. Despite the concern that bankers expressed with current loan demand, as we mentioned earlier, they are optimistic about the future of small business lending. More than 70% said long-term lending prospects were improved to varying extents by new or closer relationships fostered with customers. One banker even said that the level of customized service that we provide has allowed us to maintain relationships. Last year, 57% of bankers reported that credit risk was very important to their bank. This year, that number is down to 45%. We think this may reflect a rebound from what, in retrospect, may have been an overly pessimistic outlook, as higher provisions for loan losses in 2020 were unaccompanied by increases in loan loss charge-offs. It may also be related to the introduction of vaccines, the opening of state economies, and the issuance late last year of interim final rules that clarified the process for loan forgiveness under the PPP. So now I'm going to turn it over to Tom again, who will have further insight on the program.
Yeah, thanks, Meredith. So if we look back over the last 18 months from the end of 2019 through June of 2021, we can see here the bottom line is that the community banks increased the size of their loan portfolios by about 3%. And as shown here, C&I lending declined by 10% during this time. But when the loans and the PPP are included in that, the combined categories actually show a 28% increase. Now, non-PPP C&I lending declined by $30 billion or 10% from December to June, and this reflects a preference of business borrowers for the PPP. But it also may reflect banker preferences, because when it comes to extending traditional loans in this sector, low rates have propelled a bonanza in the mortgage market during the pandemic, but as shown here, community banks were largely bypassed as growing non-bank mortgage firms picked up market share where banks tightened lending. You can see here that residential real estate lending declined from $538 billion to $496 billion over this time period. That's a drop of 8%. On this chart, we see that community banks displayed an outsized role as a funding conduit for the PPP across the nation, with the lending broken out here by the 5 CSBS districts. We did a blog on this back in December, and we found that community banks' participation in the PPP was higher. They made more loans as a share of assets. They likely made more loans to smaller businesses that employ fewer workers, and they made more loans per bank employee. It's really all about relationship lending. You know, Alicia, in a time of crisis, we value who and what we know.
Yeah, thanks, Tom and Meredith. You know, I think that side really ties in well with last year where we had Governor Bowman, and in her speech, she said, you know, community banks were absolutely essential to the success of the PPP. And I know she'll be speaking shortly right after us, so curious and interested to see some of her thoughts. We also have a panel on PPP lending shortly, and they'll be talking or sharing some of their research on lending and profitability. So if you're interested in more in PPP, tune into that research panel. Now, year after year, we also like to ask questions on competition, acquisitions, and consolidation to help build this data time series, you know, track every year what's going on in the M&A space. We saw that acquisition slowed during the pandemic, but in mid-2021, we saw some indication of rebounding. So Meredith, could you further elaborate on what we're seeing in the M&A space?
So our third key finding from the survey is that the appetite for M&A has resumed, creating greater issues for competition. Although the pandemic slowed acquisitions, they have rebounded in 2021. More than 3/4 of bankers said that their interest in bidding on another bank was not affected by the pandemic this year, which is up slightly from last year. So while a 5% increase in interest in making an acquisition or being acquired, or a 6% increase in not being affected by the pandemic doesn't seem like a whole lot, it does mean that previous activity is resuming. And I think we actually have a good bit of evidence showing that now, as there's a lot that can be said about what's happening in real time. So I'll turn it back to Tom.
Yeah, thanks, Meredith. We all know that consolidation has been going on for a very long time. Today, the number of banks in the U.S. is about 1/3 what it was 37 years ago when I began my career at the Dallas Fed. But it looks like M&A activity in 2021 is up. The Wall Street Journal just reported this morning that there have been $54 billion in deals announced so far this year, and that's up from $17 billion last year. And it's on target to be the biggest year in M&A activity in banking since 2008, at least in terms of dollar volumes. On this next chart, though, we can see that the number of branches had increased for quite some time. It's up still about 75% more than it was at the beginning of this chart here, but it has been declining for the last 10 years. And also, in this chart, there's been an almost disappearance of de novo charters in recent years. And that's also contributing to the lower number of institutions overall.
Thanks, Tom. I know when we were putting together the presentation, we're talking about, while the number of banks has declined, heightened activity in financial technologies has likely made physical bank locations less important than they once were, as customers learn to bank from home and from their phones. During the pandemic, we saw community banks quickly, though, and safely and effectively shift to new online platforms to serve their customers with excellence. On to our next finding on technology and operations. Technology, again, continues to be a focal point of this conference, and this year is no different. This year, I think we can say that the pandemic has quickened the pace at which banks, as well as customers, have and continue to adopt new technologies. Operational and technological changes imposed during the pandemic created long-term benefits in bank efficiency and customer engagement. Meredith, can you further speak to the opportunities and again, what we're seeing in this space in terms of relationships with customers?
Sure. Thanks, Alicia. Our fourth key finding was that realized needs for operational efficiencies really accelerated new technology adoption. Operational changes imposed during the pandemic created long-term benefits in bank efficiency and customer service. More than 40% of bankers said the changes permanently increased efficiency. Decreases in efficiency, on the other hand, were only temporary. So in sum, the pandemic quickened the pace at which banks, as well as customers, were able to adopt new technologies. One such way technology started to improve was through the offering of online services. About 1/3 of respondents said online services increased by more than 50% since the start of the pandemic in March 2020. And Tom, I'm going to turn it back to you to talk a little bit more about what we're seeing in terms of operational efficiencies.
Yeah, thanks, Meredith. So efficiency improvements come primarily through gains from using new technologies or from higher labor productivity, which also, by the way, is often due to improving technologies and making things better and more efficient. In this chart, we see that community bankers continue to improve bank efficiency ratios in their ongoing efforts to be the relationship-centered bankers that their customers expect. And these gains, again, are often made by implementing new technologies. There's a recent FDIC quarterly paper, and it provides compelling evidence that community banks with more technology investment before the pandemic were better able to serve their customers as both a lender and a deposit taker amid the challenges of the pandemic.
Yeah, thanks, Tom. And I think also, I know in that article, it was also mentioned that given the rising use of digital banking channels before and during the pandemic, it appears likely that an effective approach to technology and technology investment will continue to be important for community banks in the future. We are definitely seeing community bankers share that. They are viewing technology, as an opportunity rather than as a threat. If you read through the survey results, I think one banker really summarized this well. And the banker said, we have to meet the customer's needs in new and more proactive ways, not just in reactive ways. So again, the pandemic quickened the pace at which banks as well as customers adopted new technological products, which we just talked about. So I think our next topic really fits in nicely with the discussion we just had, and that's cybersecurity, which is particularly a timely topic given Cybersecurity Month, and certainly warrants further discussion. So Meredith, can you speak to the bankers' responses on technology and their concerns with cybersecurity risks?
Our last key finding is that cybersecurity is an increasing and real threat to community banks. We know through the survey that cybersecurity risks are very worrisome to bankers. More than 80% of bankers ranked them as very important, which was more than double the rate for any other type of operational risk, and more than the 60% that was reported last year. So now I'm going to turn it back to Tom again, who's just going to talk about what we're seeing in terms of cybersecurity risks across the industry.
Yeah, thanks, Meredith. Even though technology comes with a lot of benefits and a lot of efficiency improvements and so forth, there's the downside that it gives the bad guys another opportunity to get inside their institutions. And so while we can't verify all the statistics that are provided here on this chart, the numbers are rather astounding. 238% rise in cyber attacks in the financial sector, 80% of all companies detecting a spike in cyber attacks. How about a cyber attack occurs every 11 seconds? It's really clear here that their concerns are real, and they've intensified just over the last couple of years.
Yeah, and I think these slides have been really telling. Again, it's worth noting that, every bank really needs to have a cybersecurity solution or plan in place. And even if you have one in place, it's certainly a good time to reevaluate what your bank has, in place. So I know we're running out of time and wanted to, again, reiterate some of the main takeaways. We found that net interest margins and loan demand are the most prominent challenges that are facing community banks. And again, cybersecurity ranking among bankers is top concerns. We also discussed and found that operational changes imposed during the pandemic created long-term benefits in bank efficiency and customer engagement. The survey also showed that bankers are optimistic about existing challenges or technologies, but are concerned with the costs of staying current. And last but not least, bankers expect acquisition activity to rebound from last year's low. So I know we couldn't cover all of today's or all of the survey's key findings, but if you're interested, again, check out the entire survey publication on communitybanking.org. I know we'll be having a networking reception later on this afternoon, so if you're curious to pick our brains about certain questions, feel free to join us later today. Thank you all so much, and back to you, Jim.
Great, Alicia, Tom, Meredith, thank you. I believe we do have a few minutes for Q&A, so I would like to take this opportunity to remind everyone participating about our mechanisms for doing that. First off, if you hover over your name, for those of you on the webinar tool, you will see a hand appear when you hover over your own name. If you click on that, that's a hand raise, and you can come off mute and ask your question. Also, please feel free to type a question in the chat. I will note you can, and you probably want to be careful with this, you can certainly send a note to everyone, and that's great. It's also, you're also able to send private chats to folks, and I'll just tell you, I think it's a great opportunity to reconnect with with some folks that we haven't seen face to face. While I have been listening to Alicia, Tom, and Meredith's presentation, it's been great to simultaneously say hi to a few folks via the chat as well. I did have just a private question come in to me, so maybe I'll start with that one just to get this going. And this survey has been going on for a number of years, and the question is, what data are you still looking for, right? There's, it's, Alicia, I guess you mentioned at the top of this, of your presentation that, there's some questions that come up every year, and then there's been some changes each year to try to adjust to just current conditions and things that bankers are facing. But, as CSBS thinks about this survey, and Tom, you mentioned the CBSI, what else what would be helpful to you? What's kind of maybe you have the holy grail already, but what else might you be looking for in future surveys?
I'll speak first. Like I said, we like to get responses to the M&A space, so we'll probably continue to do that year to year. I think the COVID-19 related questions and understanding business conditions will continue. And the planning committee really likes to also pick a couple of emerging issues. So I can anticipate next year maybe discussing some of the perhaps new, maybe controversial topics such as climate or cryptocurrency. And we'll be curious to see what community bankers' thoughts are on those topics. Tom, Meredith, I don't know if you have anything to add. And we'll also always continue. I know our presentation really focused on it today, but technology and innovation.
Thanks, Alicia. I would just add to that. You said a lot of what I was thinking. So, but I think we've tried to consistently keep themes over the years, just so we're able to have some time series data to reflect on. So keeping the themes of lending, funding, technology. I believe this year we had 45 questions. We try to be considerate of bankers' time in taking the survey. And like Alicia said, I believe this year we added questions, added a few more questions around technology, and then expanded upon some of the questions that were related to bankers' response to the pandemic. So I would say about 5 each year are kind of transition out, but we try to keep the bulk of the questions the same every year.
Yeah, Jim, I'll just add, if I may, that it's more of my role to try to make sense of this stuff and what's going on. And so I just want to encourage everybody that's out there that's in a research role to use this survey, to look at this survey, partner with me, help me try to figure some of this out. You can help us come up with good questions to ask. The bankers can do the same thing. You can give us good questions to ask. The regulators do that all the time for us. So that's all good. But really, this is a research and policy conference, and those things go together. And we need to have the research in order to make good policy. So I just encourage everybody to get involved with us.
No, great. Thank you for that, Tom. So I did have another question come in, and again, I'll remind everyone. So you can certainly use the chat feature, and you can message me privately, and I will keep monitoring that. So thank you for doing that. You can also send them to if you click everyone, we'll all get to see that, and then gives our presenters here an opportunity to maybe think about their answer before as they see that coming in. And you can also hover over your name and raise your hand. And for our live stream audience, conference@communitybanking.org, our team is monitoring that email box, and they are they're in a position to get questions to me as well. A question came in from somebody who already looked at the national survey that was sent out and noted that relative compliance costs declined. And I'll say this came from a community banker. Relative compliance costs declined, but that's not my experience. Can you talk about that a little bit more? What are your thoughts on that?
Yeah, I thought that was also an interesting result, since it's been climbing for the last several years. That's a hard one to verify, because we're just really asking for estimates from the banks, and then we kind of roll that up in order to kind of get that overall compliance cost. But we do know from both this survey and from the CBSI, the quarterly Community Bank Sentiment Index, that regulatory burden is a huge issue, and so compliance costs definitely go right along with that. So I think it's something we'll be watching and monitoring, but I don't have a a good reason for why it may have declined just in this last year.
That's great. Thank you. Alan Berger, I see you just turned your camera on. Do you have a question for us? Oh, I think you're on mute right now. All right, well.
Sorry, I just joined the meeting. I'm sorry, I'm a little late, so I didn't have anything. Sorry about that.
Okay, great.
But it's good to see you, Alan.
All right, so again, before we wrap this session, I want to make sure that we address any additional questions that you may have. I will note, and this is, Alicia, you mentioned this before too, that we do have two virtual receptions at the end of today. This is an opportunity for us to get a little bit more in depth on the survey and talk through any questions that you might have, and talk through some of the survey findings as well. I will note that this is an effort that starts very early on. I guess around April every year. The survey comes out, and then planning for that survey happens many months before. I would like to just note that it's a CSBS initiative working very closely with the state banking commissioners, and I just want to acknowledge the leadership of the CSBS chair this year, Melanie Hall, who is also the commissioner of the Montana Division of Banking and Financial Institutions, for her leadership, but really for all of the commissioners who really promote this survey and and work very closely with their community banks. And of course, thanks to the community bankers, Alicia, Tom, and Meredith. I know you've mentioned that a couple times, but this is there's a lot of attention paid to asking questions that we really can't get anywhere else, right? There's a lot of data out there, and all of the agencies that sponsor this conference, the FDIC, CSBS, and the Fed are very good at accessing that data and drawing conclusions. But this survey certainly provides some new insights, and we've even had some research that has come about over the years. So one quick question, and then we'll pivot. Have any bankers brought up climate risk and as an emerging issue?
I can answer that. I mean, it's obviously a concern that a lot of policymakers and folks are talking about. But I'll answer it just because in the Community Bank Sentiment Index, we asked a question on what concerns do you have, and it has not raised to a level of what I would call a huge concern. Alicia, I think it was also in the this year's conference. Can you address that in this year's survey, annual survey?
Yes, there was a question that was asked more in terms of how banks are viewing it as a risk, and I think based on some of the feedback that we've gotten, even getting this question asked, we will probably continue to flush out more questions in hopefully next year's survey as well.
Yeah, there was, it was just the one question that we had around external risks, where we had identified a number of external risks, and climate was one of them. And actually the response to it was pretty minimal, in that many bankers did not foresee it being a large risk to their bank at this time. I do think, yes, because continued research is needed, that it may be something we explore further next year. But I believe we nod to it in the conference publication, but there was not a lot of discussion about it.